In this video, you'll be learning about this topic.
So Ed, how in the world do we as investors position ourselves to take advantage of the debt situation in the most developed nations?
Yeah, I think really it's a question of what are nations forced to do to keep that debt level from rising more. And generally speaking, what that is to, going back to our earlier discussion, thinking about growth and in the absence of real growth, inflation and currency depreciation. And obviously, what that really means is financial repression if you can't get growth. And financial repression is basically negative interest rates on a real basis. So I may be earning 2% on my bonds, but inflation is 3%. Or I may be earning 1% on my bonds, but inflation is 2%. So I'm getting a negative return after inflation. Gold, silver, even Bitcoin, they look pretty good compared to that. Now, gold, you don't earn a return on that asset. But when real returns are negative, obviously it makes a lot of sense to get nothing and to have a store of value than to be penalized for actually holding things and getting a negative return. And we know from Europe, Denmark, Sweden, Switzerland, and the Eurozone, interest rates are negative right across the board. And so not even on a real basis, but on a fundamental basis, you're getting a negative return. You're guaranteed to lose money when you buy the instruments, government bonds. That's a situation in which other stores of value will do well, and potentially commodities, hard assets in general.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.